All right. Hello. Welcome everyone. So, for those of you who haven't been to any of our Zoom sessions, obviously I'm Victor, and we've had several of these. We usually have a topic, and we discuss different things regarding to the topic. Today's topic is the covered call dividend strategy. So we will probably be putting most emphasis on the CCD strategy, but we can discuss other things as well. I'm open to that idea. So um, it's kind of just like an open forum. We can go back and forth, and if you have questions, just feel free to ask them, and we can discuss different things and kind of take it from there. We're gonna do this for 1 hour until 11 a.m. Eastern Standard Time, and I think we should have an interesting discussion, and we can talk about some about some good stuff. So I see there's quite a few people in here already, so I mean that's good.
That's good.
So I mean we can go ahead and start. Uh,
Start.
let's see who wants to kick it off with a question about CCDs or whatever, anything else. I have your mics on mute when you come in the room, but just feel free to unmute yourself and we can begin. So who wants to go first? Apparently no one wants to go first. That's okay. So as soon as anyone is ready, just feel free and we can begin. For now, we can just kind of take a look at markets and see what's going on here. So we see actually the S&P is pushing higher, so that's a good thing. I'm thinking we can probably either see a continued consolidation, maybe a bit of a pullback, not too much probably, but in a more bullish case scenario, we can probably continue to melt up into year end. So I mean that's kind of where we're at here. As you probably saw, we opened some new CCDs yesterday. So SMCI is high on the list because we got some news out on the company, and it's not really the best news we want to see at this point. There's some shares.
Hello.
Yes. Okay, there we go. I heard someone. So that's a good thing.
Je sais pas comment ça marche.
Yes.
Hello.
Go ahead, Francois.
Hello. Good afternoon or good morning. I'm
Thank
François
you.
from France. And thank you for organizing this kind of meetings. I'm not comfortable with Zoom, so sorry if I
That's
make some
okay.
mistakes.
No problem.
And
This is new for,
this,
yeah.
okay, the CDDs are the strong part, one of the main part of your strategy. And I made mistakes in the past because I don't follow your kind advices. So I don't did it. And I think it is easy to do, but you can give us more explanation. And I made the mistake at the beginning, but now I am on uh, what interactive brokers,
Uh-huh.
with right? And
Good.
it's so easy to do.
Yeah, it's not that difficult. Once you get that initial once you get over that initial step of doing it for the first or maybe just a few times, it becomes like second nature, and it's really not that difficult. So I agree with you there.
Okay, so I'm here and I'm listening what you have to say more about that.
Okay, good, super, Francois. Excellent to have you, and
And
I'm glad
say
you're here.
hello to everybody.
Hello, Francois, from everybody. Okay, yeah, good. I mean, the way I view the CCD strategy is that
Yes.
we wanna we don't wanna limit our upside with in stocks. We want to do it as a complementary strategy to increase yield. So the best time to implement it is when the stock is around its near-term high. That's like say we're looking at Palantir, right? I'm just giving you an example, and maybe we think that it hit, that it reached, and that it's overbought, and maybe it reached a near-term high around $20. So maybe we want to go with like a $22 CCD just in case, um, just in case it shoots up quickly, and even if it does get taken off our hands, I also don't like to do the full positions. That's why I do 20%, 25%, especially in the core holdings, because if the stock shoots up, fast, maybe I won't be able to, maybe I won't want to buy back the CCDs at a huge premium, at more of a premium than I sold them for. So maybe the stock will end up getting, will get taken off my hands, but by the expiration, on the expiration date. So this way, we're not going to limit our upside too much. In an ideal case scenario, we will sell the CCD on a position that we have, that that we're going to hold for a long time. We're going to get a nice premium for it. The stock is gonna trade sideways or go lower in the near term. We're going to buy it back for pennies on the dollar, preferably, and then the stock will go back up, and we just got the premium, and that's it. So that's the ideal case scenario when it comes to CCD. So there is some timing. There's definitely a timing element that's involved, and we need to be aware of it, basically.
Hello, Victor. This is
Hello.
Antonis.
Hello, Antonis.
Uh, I follow your I read your text and follow your guidance in a daily basis, and I thank you for, first of all, for the insight, because I'm not very much related with the stock market. I'm an engineer, so it's good to have someone full-time dedicated to that.
Absolutely, that's why I'm here.
And I realize you're using a CCD strategy every time that you feel that the stocks will fall. You're buying CCD, but for me this process is not really clear. I have no clue even how can I open a CCD position. I am using this online broker, mostly Saxo Trader. Can I do it through this application?
That's a good question. I'm not familiar with the Saxo Trader. So basically, I can break it down like this. The covered call dividend strategy, it's basically just selling covered call options. It's considered the most basic and the least risky options strategy out of any option strategy, because basically, you just own the stocks, and you're creating, I mean, the at the core of the process, we are creating the call options, right? We're just basically creating them out of thin air, and we're selling them to people for a premium, which is basically, it's a no lose situation. I mean, the only way we can kind of look back and say we did something wrong is if the stock goes significantly past
very fast.
Yeah, so if it shoots up, and we say, oh man, we could have made a lot more money without implementing the CCD. But
even in this case, we make some money.
Exactly. Even in this worst case scenario, we still make money. So basically, it is the safest, the most basic options strategy there is. And I'm not sure if you're filled out the options applications strategy, to trade options, but it's the one that is the initial one that you do. It's the one before before buying the put and the call options. It's the selling the call option strategy, the CCD strategy.
So
So
can you?
yeah.
Sorry.
Yeah, I know brokers like you know that are in Europe. I know that Interactive Brokers of course has it. I'm not sure.
eToro, that they have account in eToro as well.
Oh, okay. I don't know about eToro. I'm not sure. I like Schwab a lot. I'm not sure if it works. It's actually the former Ameritrade, because it has like the most user-friendly platform when it comes to CCDs. It's just like super easy to do. I'm not sure if Schwab is available in Europe. That's something that we need to check, but possibly it is. And that would be the best platform, in my view, to start doing the CCD strategy, because it's so easy to do. It's actually in my view, it's far easier to do than on Interactive Brokers, just because of the user friendability, the user friendliness of the platform. Yeah. So yeah, sorry. Antony, I would Antonis, I would look online exactly which online broker offers the covered call dividend
The
stuff.
covered call option.
I think, yeah, I mean, most of them should, because like I said, it's the most basic of the options strategies. So
I understand.
yeah.
One more question, another question, which is
Yeah.
again very basic.
Yes.
There are some numbers or some how we call it. Anyway, there are some text and symbols next to the option. For example, you say I open Palantir option 25%. How it works? For what is the time horizon? When you can cash out? Can you? But briefly, because maybe it's not a question that everybody
it's easy.
has.
So I'm gonna write something like I write in the weather portfolio room. I write like whatever, so CCD, and then I usually put the expiration date, like 1/19/24. That's the date when the options expire, basically. If so if the price of if you still have the CCD on at the expiration date, and the price goes above the strike price, then those options will get taken off your hands. That's basically, I mean, I'm sorry, the stock will get taken off of your hands for that strike price that you initially sold the options for. So that's how that works. So the first number is just the expiration date, and then next I'll put in like you know, for Palantir I'll put 20%. That's 20% of the entire position. So out of 100,000 shares, that's 20,000 shares that we're doing the covered call options on. And then the next is I put like 22 SP. That's the $22 strike price.
So let's assuming today the stock market is around $20 then, right?
Yeah, the stock is around $20. So I'll do like a 22 strike price CCD, just because I want some cushion, just in case maybe Palantir shoots up, maybe, you know, anything can happen. So I'll also make the 10% on the $2, plus probably about you know, whatever the premium for the option is, another like you know, 5 to 10%, whatever. So that's a pretty good gain there, regardless. I mean, we can even go as high as 25 on the strike price, but typically it would be better if there was like an earnings call before, because we would get a much higher
but I guess the bigger you open this margin, that means you reduce your risk. That means you reduce also your profit. Am I right?
Yes, you are correct, but one element of the strategy that many people or some people may not put too much emphasis on or focus too much on is that I plan to buy these options back. I don't plan to let them, to let them go, go on to until
The
January
expiration
next year. I would much prefer that Palantir declines by about maybe 10% or so in the near term, or 5 to 10% in the near term, and then I could buy those covered calls back for basically pennies on the dollar. Like maybe if I sell them for like $1 for each option, if the stock goes down by maybe around like 10% or so, those options are going to be selling for 20 cents. You know what I mean? So I'll be able to buy them back for basically for pennies on the dollar, maybe even less than 20 cents. So
And you can buy anytime you like.
yes, absolutely. You can buy them back anytime you like. Sure. That's
So
the beauty.
if the stock falls, you decide how much it falls and what is good for you, and you can close your position if it falls. If it goes up, you can do the same, lose some money, and buy your position back if you think the momentum is very high and going good, or you wait to expire and you get what you get if it expires. I get these $2 that we said before, the 10%.
Yes, plus the premium for the covered call option. So
okay, very clear, very clear, very clear. Thank you very much.
You're welcome.
Thank you.
Well, Victor, you talk about. Excuse me.
Yes, Fred.
This is Fred talking.
Yes.
Question about buying back at pennies on the dollar.
Yes.
That occurs if you buy it back very quickly, I believe. But if you wait a while, as you said, as the stock price goes down, you can buy it back cheaper. But if the stock price goes up a little bit, the buyback premium is going to be more expensive, right? And then the longer you wait, the bigger the loss when you have to buy it back. Is that correct?
Well, only if the stock continues going higher while you wait. If the stock trades sideways, like for instance, if the stock trades sideways, that options premium, it's going to erode. It's going to decay. So it's that option tends to get cheaper. If I'm not mistaken, most options, like I believe like maybe 90% of them, they expire like worthless. So basically the time factor, it's on our side, unless the stock it's in a very bullish position. But that's we kind of shy away from selling covered calls at such instances, like when a stock is near a significant bottom, or if it's like a high momentum stock and and it's not overbought yet, then we want to probably not do the covered call then. But if we see even like a momentum stock, like we can come back to Palantir or whatever, Nvidia, AMD, doesn't matter. Like once we see a big run up in the share price, and we see that it's like technically overbought, we see the RSI at like above 70 or 80 or whatever, like for instance, I'm bullish on the company PDD, the PDD Holdings company, but I sold cover calls on it yesterday just because it had such a massive run up. I don't believe that it's going to go above $150 in the next couple of weeks. So I think there's a higher probability. It comes down to probabilities in the end. So I think there's a higher probability that it's going to decline maybe to 135, 130. So there's a pretty high probability that I'll be able to buy those covered calls back for if not for pennies on the dollar, significantly cheaper than what I sold them for. So that's kind of how I look at it.
Okay, that's good. I'm looking at Apple stock, for example. I have a fair number of shares that I'd like to sell covered calls on, and that stock is not too far below its all-time high,
Mhm.
and it has been moving very slowly. It had a pretty brisk run up recently, but it looks like it's up there at a pretty high price right now, and doesn't appear to have a lot of excitement associated with it going up very quickly.
Yes.
So it would look like a good candidate.
Yes, it's not a bad candidate. The only thing about Apple is that it's not a very it's not, it doesn't have very high premiums for its covered, for covered calls. That's like the only downside in it. If it, if I could get if we could get like a 5% or even a 4% premium for the 200 calls, that that's great. I think that would be like a no-brainer. But I'm looking at it now, and for January 19th, we're looking at $1.40. So I mean that's well below 1%. That's like 0.7 or something, 0.8, 0.8 of 1% or something like that. That's not really a great premium there. If we're looking at 195, we'll get about 1.5%, which is it's also, relatively low in my view. So Apple, that's the downside with Apple and other companies like Apple. I guess you would call them maybe like value companies, even though Apple has a multiple of a growth stock. But the premiums are really not that good in Apple.
Okay, I understand. That's inherent, I guess, in the fact that it's close to a value type stock.
Exactly. That's the downside
Yeah.
there.
Okay, gotcha. Thank you.
Victor, can I ask a question?
Yes, of course. Please.
Yeah, I'm careful. Thanks for organizing all these great things and also coaching us. I got basic understanding last 1 month, and when I'm about to execute it, especially on your update on CCD plan, the CCD price is already went down significantly. So there are some timing issues. I'm not usually that shy in buying new stock, but updated by your new CCD plan, and you already executed it. And when I'm about to execute it, for example, Tesla, for example, SMCI, I should have followed you 2 days ago for you. And when I'm about to look around and execute it, it's already option price went down 20%, 30%. So I just thought it's not good time to get in. And my second question is, when I looked at your previous histories of selling CCD and buying back, of course, market is evolving, so there's no best time to buy, get back. But you relatively bought it back very shortly, 1 day or 2 days later. Just as soon as you saw some return, you just buy them back. That's my second question. And the last question is a minor technical thing. When I saw your articles on CCD plan, the percentage ratio of premium, is it premium price over strike price? It's almost the same, but a little bit variations from that. So I would be appreciate if you explain
Yeah.
in detail on that. Yeah,
Sure.
that's all my questions.
Okay,
Again,
so
thank you.
let
Yeah.
me start with the third with the last question first. So about the article and the CCD premium. So usually when I compute the premiums, I don't go by the strike price. I go by the market price, by the price that the stock is at. So that's how we derive the premium. It's
I
just
see.
that oftentimes I I write about the strike price. That's just the first out of the money strike price. So it's very close to to the market price. So that's probably why we're seeing like minor variations there.
Ah, I see. Got you.
Yep. And regarding your second question, I'm sorry, can you just quickly remind me exactly how you
Yeah.
formulated it?
When is seemingly the
Ah, yes,
best
yes, I
time to
remember.
buy
I'm sorry,
back?
I'm sorry.
Just as soon as you see some
Yeah.
return, or
Yeah.
just let's wait
No,
and see.
no, it's
Yeah.
not. It's not when I see some return. It's more like an intuitive thing, like intuition, basically. I hate see. I've had several instances where I've let stocks go past the strike price, and then like it happened with PDD. If you notice, even here, I had in this this quarter, I had half of my PDD position exercised at $80 because because I had the call option on, I had the CCD on from last quarter, and it went past, I had the $80 strike price. I didn't buy it back in time. So it kind of just blew by, blew by the strike price. And I
I
was
see.
considering like buying it back, but then, I said it'll probably, come back down, but it never did. It just, it's almost doubled since then. So obviously that's not something that we want to do. And it's happened with other stocks, not just with PDD. I mean, it happens periodically. So I try very, very hard so that this doesn't happen. That's why sometimes I close the CCD positions, relatively quickly. If I feel, that a stock could go higher,
I
uh,
see.
I just kind of more like it's more of like a safety mechanism, so I don't lose out on upside potential. And then
I see.
yeah. And then on the downside, it's also like more intuitive, because like if the stock drops some, and I see that it's probably going to recover soon, I'll just buy the CCD back, and then I'll have some profit. It's not going to be like, it's not going to be maybe like a great deal of profit, but it'll be some profit. And then, the stock will probably, or it could rebound, and then we have options. Then we can either just hold it and see if it goes higher, or we can we can recycle the CCD. We can write a new, meaning we can write like a new CCD with a higher stock, with a higher strike price. So it's basically, it's more of like an intuitive thing more than like take small profits here and there.
Got you. Got you.
I hope that makes sense. And for
Yeah.
the first part of your question, sorry, can you just
Yeah, no problem. And sorry for lengthy questions.
that's okay.
Yeah, just you executed and you published CCD plan. You already sold some CCD. And when I'm about to execute it half a day or a day later, the option premium already went down 20%,
Yeah.
30%.
The
That
options,
case, yeah.
yeah. I
I had a better buy, or I had a better not I had a better sell, or I had a better not sell CCD.
yeah. So the options, they move very quickly. So the premiums, they can go like 20-30% in a day. If a stock moves maybe by just like 3 or 5%, we can have a 20-30% move in the options price. So basically it just comes down to the price. If I sell the CCD when the stock is down 1%, and then I always put it in, put in like in real time. Sometimes I even try to do it ahead of time. I'll write, I don't do this all the time, but sometimes I'll write, I plan to like today I plan to do CCDs here, like in these companies. I should probably do that more often, because that would give you guys more like more time to just basically formulate a plan. I understand it can be it can be difficult to, you know, if I send like out an alert and then you know, you may not see it right away or whatever. And then if the stock just moves like, you know, moves down by just like 2% or so, you know, the option can move by 20%. So
I see.
that's kind of how, I mean, that's how that works.
Got you. Yeah, that's market characteristic. Okay, pretty clear. Yeah, thanks for organizing all this again.
Hey, it's my pleasure. And I'm
Yeah.
glad that you guys are here.
Yeah.
Okay, cool. Next question.
This is Jeffrey in Tennessee, the USA.
Jeffrey. Hi, how are you?
I'm good. I've followed the CCD concept for a while, and there's one thing I want to make sure I understand, which is problematic for me, and that has to do with account size and the fact that I typically go for, you know, like 5% as a max on a move in the account that I've got, with exceptions. Plantier, I went to 7 or 8. I was like, you know, okay, this looks good, and I was glad I did. But the stock price then winds up being important, because my understanding is the basis for this is you have to buy 100 shares. So if you have like $150,000 or $200,000 account, that kind of limits the stock price per share that you can do. Am I right about that? There's no way you can do partials, right? You can't do 25 or 50 shares. It's all at 100 shares.
Yeah, just 100 share blocks.
Okay. So to me, that means that the stocks that I buy in the CCDs, are out of my range for certain stocks, and I just need to put that in my planning and do CCDs only with less expensive stocks, since I have to hold 100 shares to do it, right? In other words, the basis is you buy 100, then you can start doing the options.
Absolutely. Yep, that's
Okay.
that's
All
how
right. So that I just worked my way up.
Yeah,
All
I mean, yeah, and I definitely understand you. It doesn't, it's not something that, you know, that we can do with like, you know, any stock, but we can certainly do it with many stocks, and that's, you know, that's a good thing.
Well, so then it seems to me like what you go for is the volatility is driving the price. If I understood what you're talking about with Apple, the premiums are very low because nothing's happening, right? No,
Exactly.
there's not a worry about, oh, gee, I need to cover myself because the thing is moving slowly. So it sounds like the target then for me would be stocks that have more volatility and the share price that works for me.
Sure. Yeah, absolutely.
Okay,
And also,
I understand.
market conditions, you know, they impact the premiums a lot. So I mean, in a more volatile market, we're going to see options premiums shoot up. Before earnings, we're going to see options premiums, you know, much higher than after earnings.
Good point. So all of them are likely to see more movement right before earnings.
Absolutely. Yep.
Okay. Very good. That makes perfect sense.
Yep. That's something that
Cool.
we should always consider.
I'm good. Thank you.
Cool. Thank you, Jeffrey.
Yes.
Charlie Kurtz from Pennsylvania. I am a newbie on this, and I understand the concept. I just haven't executed anything because I want to make sure I understand. Why do you buy the options back? Why not just let it expire?
Yeah. I mean, that's a fair question and a good question. And the reason that I buy the options back is because I don't want to limit my upside in
Okay.
many stocks, because, you know, like we'll go back to Palantir for a second. It's around $20 now. So I sold the $22 strike price CCDs, but it's such a momentum stock, and it's such a, you know, it's like one of the most popular stocks now. So I mean, it can easily go above 22 and then go to 25, and then I'll be kicking myself for you know, for losing,
Gotcha.
you know what I mean? So
Yeah.
that
Another question. Okay, no, that makes a lot of sense, and that's what reason I thought it. What was my other question? Oh, is there a wash rule if I lose the stock? Okay, so I don't buy back the option. Stock call. Can I buy the stock back immediately? Am I in a different, you know? I've lost 20%. Can I buy that 20% back, or is there a wash rule, like the IRS has?
So if I understand you correctly, once like say you have a stock and it goes it goes above the strike price on expiration date, the stock gets taken off your hands, and then you buy the stock back. I mean you could, of course. Oh, you're talking about how it works. I can't, that's something that I can't really speak on. That's something that probably an accountant would be
Okay.
yeah, that's a question for the accountant.
Yeah, one other question. Can you recommend any good books on this subject?
Good books on covered call strategy. I'll be honest with you, my uncle taught me the strategy a long time ago. He was a very successful trader on the NYMEX. So he taught me this strategy maybe like 15 years ago, and I've been implementing it ever since. I can't really, I haven't read any books on it, so I
Okay.
can't speak on that.
Well, thank you for all your help. Appreciate it, Victor.
Thank you.
Hey, Victor.
Yes.
I bet
This is-
that Schwab probably has good educational information on covered calls.
Yeah, I would think that they do. Schwab is it's quite the platform, and they
I
bought
know
out.
that Fidelity has some good information on it.
There you go. I'm sure they do. Excellent. So there's some options we can look at what Fidelity has to say and what what
Hello?
Schwab says about it. But it's pretty basic. Like honestly, I can't really think of what a whole book would be on concerning covered calls, but I'm sure there's
Check.
some good information in there.
Hey, Victor.
Hey,
This is Ben. Got a couple of quick questions about rolling a covered call,
yes.
right? If there is a stock that's picked up some momentum, we thought actually it was going to go sideways or down,
Mhm.
but instead there is a market event, something happened, and the stock's going up,
Yes.
and it becomes very expensive to buy it back. What is the possibility of rolling it into another expiration further down the road, hoping that some of this volatility is going to come down and you may be able to buy it back at a better price?
Yeah, I mean, you would still have to buy it back and then go with unless you had like separate positions, you would still have to buy back your original covered calls and then sell covered calls with a higher strike price, if I understand your question correctly.
Yeah. Yes.
So, I mean, that's something that we would need to do on many people, and I've seen actually, I'm not sure if it's for the Fidelity or Schwab, but I actually read about this somewhere in one of these places. So I mean, yeah, I've heard it like discussed as like as a viable strategy, and it could be, but I think it takes a certain kind of stock. It would almost have to be like you would almost need to know or be very or be very confident you know where it's going to kind of continuously implement the rollover strategy. But it could work if you have a good feel for the stock market or a stock. It could work, and I do it sometimes. Like if I have a stock, and I mean typically if I have a stock and I feel it's going to go through the CCD, through the strike price, I you know, I'll buy the CCD back, and I'll probably give it some time to appreciate. I don't typically like roll over right away. But you know, if the momentum is like really steady in a stock, and you have a good good feeling where it's going to be maybe in a month or two from now, then it's something that, you know, it's something that we can explore for sure.
Yeah. And also when you are doing CCDs, your general guideline is look 4 weeks out. Is that a good strategy?
4 to 8, yeah, basically.
48, okay.
It can be less if there's like an event, or if there's increased volatility. It can be, you know, it can be even like, you know, 3 weeks, or sometimes even 2 weeks or something like that. But typically when there's like no earnings and no like major events going on, then we want to look for something like, you know, 4 to 8 weeks usually. I don't like
Yeah.
to go longer than that.
Right. And also notice that most of the times when you're you know, chatting in the chat rooms, you use the RSI indicator a lot. This is something new for me. I'm just learning that. So basically what you're doing there is, you know, if it goes above 70, you're looking at it's overbought. And so that's a good time to do a CCD.
Yeah, I think again, it's stock specific. So I mean, some stocks can stay like overbought for a very long time.
Mm,
You know, just, you know, take a look at Nvidia. While, you know, for it's, you know, its RSI went above 70, 80, then it came down, then it went, you know, shot up above 78 again. But again, we can kind of when it gets really overbought, even in Nvidia, we can, you know, we can implement the CCD, and then buy it back when the stock declines by like 5% or so. The CCD will drop by quite a bit, so it would be a good time to buy it back then. And then we could, you know, we could institute a new one, and kind of play around with it. But yeah, we definitely want to keep an eye on technical conditions when we implement the CCD strategy. And if we see the RSI and other technical indicators getting like, you know, really overbought, you know, signaling that the stock is really overbought, and we don't want to, you know, we don't always want to reduce positions, or sell the shares, especially in a bull market. If like, you know, if we see that it's maybe like a near like a long-term top, or we're close to, like, you know, or it's, you know, we see that there's like a bear market on the horizon, kind of like what happened in 21, then we reduce positions, and we, you know, we implement CCDs on remaining positions, and we implement collar options and things like that. But in a typical market, you know, we don't want to be, or it's just not practical to like reduce core positions by like 50% or something like that. So even if a stock gets overbought, it's more practical to implement the CCD strategy, because again, we get the nice premium, and then, you know, we can always buy it back, you know, hopefully for pennies on the dollar, and we can kind of, you know, just make extra money this way. And it, you know, it works good in the long run.
yeah. And also the last question I have is for SMCI, we sold 50% of our position today. Yeah, and the RSI is below 34 or something like that, you know. And also there is a market event and news that came out that they're diluting a lot of stock. How did that play into this particular sell?
Yes, I mean, basically, I wasn't expecting that, you know, that they would be offering shares here, and you know, it's not really something as a shareholder that, you know, that I want to see in a profitable company that's, you know, that's a momentum stock, and it's got such high you know, high hopes around it, I guess. And I realize that it's, you know, it's the hardware side of AI, and there's, you know, there's other factors involved in it. There's just some intuition also here that, you know, maybe it's better to reduce in SMCI for now, and we'll see how the stock behaves here. But I'm not looking at it as like a favorite anymore. I thought that this dilution was it's not really something that I was expecting to see. So when I see something unexpected like this, there's something, you know, how they say when there's when there's smoke, there's typically fire. So, something I'm not saying that there's like a critical problem, probably not, but still I just want to be more cautious here. So I'm gonna cut some exposure here. Maybe I'll do like another CCD for the remaining 25% or 50%, and we'll see how it goes. But
Yeah, yeah.
but yeah, but it's definitely not something that I was expecting, and it's not, you know, it's not great news.
All right, I appreciate that. Thanks so much.
You're welcome. Okay, so we still have quite a few people that haven't asked any questions.
Can I ask?
Yes, of course.
This Kuldeep Singh. So my portfolio is small, and there was no way for me to basically buy those stocks with 100 things. So I bought calls in the money, deep in the money. So when you say sell 50% or 20%, it's difficult for me to do that because I have only limited number of shares or calls. So I was not able to really implement that. And secondly, you move very fast, and I'm working, and by the time I see you did something, I'm too late. So, and then some of the stocks are volatile. So my question is, can you add some ETFs? They are kind of go a little steady, and then even if you sell those CCD on ETFs, they don't move like crazy.
Yeah. Okay. So let's do the ETF side of the question first. So the ETFs, the reason why typically we wouldn't implement CCDs with ETFs is because the premiums on most ETFs are not high enough. So I'm not going to implement a CCD if it's going to yield me like 1 or 2% most times. I'm going to go for a CCD that's going to typically give me 4% a month or more. Sometimes there are exceptions, but I will look for for that probably 4% minimum, preferably more. And ETFs, most ETFs just don't offer those, and also many ETFs don't have enough volume, and the options on the ETFs, they have even less volume, so that that kind of makes the spreads big, and ETFs are not great for CCD strategies. So that's one factor. The other factor is that I want to emphasize that the holdings in the all-weather portfolio, they typically do well even without the CCD strategy. The CCD strategy, it's not something that is imperative, or that that it's not something that it does add some yield, of course, but sometimes it backfires, like with PDD, or with I've had it happen with Palantir in the past, and Amazon, like where where the stock goes above the strike price, and you actually don't make as much money because of the CCD as you would without it. So my point is that the all-weather portfolio, it's geared to do well even without the CCD strategy. The CCD strategy, it's more of a bonus. I look at it more of as like a bonus to just make extra yield in volatile situations, basically, and kind of profit from that. But it's definitely not something that is imperative, or that I think that we can do all right. We can do pretty well even without implementing you know, the CCD strategy all the time.
So my another question is, since my portfolio is small,
Yes.
I cannot have everything that is in the all-weather portfolio. So I have to just pick and choose a few here and there, and they may not work. I'm afraid sometime, you know, because all stocks are different. So what do you recommend, kind of?
I recommend this. I recommend looking at the all-weather portfolio at the core positions and kind of starting with those. And I would also recommend looking at the badly beaten down positions, typically the ones with the highest TT trade trigger scores that I call them. Basically, if I, you know, if I look at the all-weather portfolio, I see that, you know, stocks, for instance, like Block, SQ. I mean, this stock was just hammered relentlessly, and it's a good company, and there's good news about the company. And I was on it, you know, when it was around the bottom, I was kind of pounding the table on it. And I still think that, you know, a stock like this can go much higher. Palantir, it's riskier. I mean, it's riskier in the near term just because it's the valuation's high, but you know, longer term, I'm very confident that Palantir can go much higher. AMD, another stock that, you know, I would definitely consider as a core holding for any portfolio. It has immense potential. A stock like Zoom, you know, we're using Zoom, so it's appropriate. But Zoom, it's so cheap, and it, you know, it was even cheaper, and I just think that it's ridiculously cheap here. Match.com, like, I mean, it's not, you know, this is not like a typical stock, but it's so cheap. It's like it trades at something like a 10 or 12 times multiple. It trades like a value company. It's an internet stock with growth. It's crazy cheap. So I mean, I would definitely consider that. Nvidia, excellent potential. Long term, it should go much higher. It's the evident leader in AI, so for sure consider that. Even if you don't have the most significant portfolio, you could, you know, you could probably, you know, own some Nvidia shares. Twilio, same thing. It's a software company, but it trades very cheaply here. So I would consider these. And then on the lithium side, I would look at Albemarle, very cheap. Livent, extremely cheap. So I would definitely consider some of these stocks. Also, we can look at the gold and silver miners, because gold may be on the brink of, and silver may be on the brink of a breakout, because you know, we're approaching all-time highs in gold, and these stocks like Barrick Gold and like you know, Kinross Gold. These are not like the typical companies that, you know, you would have, you know, most people would probably have in their portfolio if they have like 10 or 15 stocks. But we can definitely kind of pick these the stocks with like the highest probability of doing really well in the near term. You know, we don't need to go with all of like the 50 or whatever, the 60 holdings that the all-weather portfolio has. We can formulate an excellent portfolio with just 15 or 20 holdings.
Great, thank you.
For sure.
Hey, Victor, on the TT score, I was trying to recall what that is. The higher the number, the more confidence, or what does that mean, I guess?
Yeah, I mean, that's basically it. But you know, there are other factors involved, like technical conditions and you know, risk reward, fundamental factors. But basically, yes, the higher the number, the more confidence I have in the stock doing well, especially in the near term. It's not like a long term I guess TT score, because you know, in that case I would have Tesla higher. Yeah.
Donc j'en ai acheté que 10. Et
Gotcha. Then the other thing I was going to ask you is, do you typically rebalance at the calendar year like a lot of portfolio managers do, or are you intending to kind of stick with what you've got once you get into January?
Yeah, I rebalance every quarter, but it's unless the market conditions are changing, are going to change a lot. I'm not gonna like do anything too crazy. I'm not gonna rebalance too much. Typically, probably I'm gonna keep it close, but we'll see. If there's if like if the odds of recession increase, of course I'm gonna decrease some positions, increase hedges, increase cash. You know, that's if the probabilities of a bear market or recession increase in the new year. But for now, it looks like the Fed is moving toward an easier monetary stance. So I'm kind of just positioning the portfolio toward more gains in the future. I mean, I think we're going to have a good year in 2024. I mean, that could change, of course, because we don't know exactly what's going to happen. But for now, the economy seems, I guess, stronger than anticipated, and we have a lot of a lot of positive data points, even though rates are high, and there is like that there are some pockets of concern, like the housing market and the consumer in some cases, but I think we can probably the base case scenario is still a soft landing scenario. So that's kind of how I'm positioning the portfolio for the new year.
And then what about I know the banks and the oil and gas sector haven't really participated in the run that we've had. It seems like the banks are starting to get pretty stable right now, and it could be the calm before the storm. But what's your kind of take on some of the larger banks, and even, I know you said the oil and gas, you're thinking that the price of the WTI and everything may go up fairly soon, but I'm personally heavier weighted on oil and gas. I had a good run in 2022 through that, and I've kind of kept it as a balance.
Yeah.
But I feel like that the supply is going to just continue to contract, and we've got room to run on that front. But I'm just kind of curious your take going into this next calendar year and positioning there on those two fronts.
I'm with you. I think that if we can avoid a recession or a significant slowdown, I think that supply is going to remain constrained. So we should do well in the oil and gas sector. So I like it. I think it's a good place. It's actually a place that I want to increase in. Because we had a nice decline in oil, and we had a nice correction in many high quality oil stocks. So that's an area that I think you're spot on. That I think we can have a higher allocation than my portfolio has now. As far as banks go, we've had a good run up recently in a lot of banks. So there are issues like lower interest rates, lower interest rates are actually a negative for banks, because they're going to be making less less in a
margin.
Yeah, they're on debt payments, so they'll be getting less money on that, and actually every 25 basis point cut, it cuts into bank profits quite a bit, I think. So that's something that we want to stay vigilant on. And also there are some concern of non-performing loans and higher defaults and things of that nature. So that's something that we also need to keep an eye on. And if concerning banks, I would focus on the higher quality banks like JP Morgan, Goldman Sachs. Citi's cheap, but if things go south, they're probably gonna feel some pain, because it's not really as well managed as JP Morgan and some other banks.
What about Bank of America? I know they've got a lot of they've got a lot on their balance sheet right now, that with the rate changes that have hit them, that their paper losses right now, but in the past they seem to be pretty well managed and everything. I'm just kind of curious what your take on them is.
Yeah, Bank of America, it's not bad. It's actually I think it's
C'est moins 20 qui m'ont fait des euros.
it's in the middle. I think it's about it's not quite JP Morgan status, but I think it's better managed than Citibank and even Wells Fargo probably. So I like Bank of America. I think it's in, you know, out of the major banks, it's one of the better ones. So I do think Bank of America has potential, and if they can, you know,
Moins
if
de
they can avoid some big write downs, they should do well.
Thanks, Victor.
Yep, you're welcome. Guys, I'm sorry, it's well, here it's at 6 o'clock, 6 p.m., but it's 11 it's 11 a.m. in New York, and it's 6 p.m. here. And you know, it was a 1-hour session, so thank you all for coming and participating, and it was excellent. I had an excellent time speaking with you guys. And I look forward to our next CCD session. We should we used to do this as a recurring thing, the Zoom meetings, but we had some you know, I had I had an addition to the family recently, so you know, it's been time consuming. But I think we can return to maybe doing, you know, at least one Zoom session a month. I think it will be beneficial for everyone. So
And you save the recordings, don't you, Victor? With
yes,
the
yes, of
recordings?
course.
Thank
Okay.
you.
Of course, I do save the recordings, and I will publish this recording for sure. So yeah, I hope it doesn't get corrupted. It shouldn't. So I think I'm doing everything right here. So yep. Thank you. I'm getting some thank yous in the
Thank you, Victor.
Thank you so much, Victor.
Thanks, Victor.
So, thank you very much.
you guys.
Thanks, Vic.
Okay, bye-bye.
Bye bye.
Thank you. Bye-bye.
Bye bye.